A new financial year has begun, and let me share my thoughts on what I expect from the markets in and what we should be doing in our investment journeys. The first 3 months from Jan to March this year was super volatile, as you know. It started off with the tariff announcements by US, and March was obviously extremely brutal because of the US Iran war and the escalations around that. Oil prices spiked up, and India, being a net oil importer, has a big micro impact because of that. As we speak, we are in a ceasefire mode. We are hoping that the worst of the war situation is behind us. In fact, the market is also expecting the same. Crude oil prices have corrected. The equity prices have gone back to reasonably higher levels from the lows of March. We cannot say that it is all behind us. You never know what announcements come from US or Iran because both are extremely volatile and uncertain regimes. So we cannot be 100% sure about anything at this point. However, my base case is that the worst of the war is behind us. So what do we expect now going forward? I think there are three important triggers which will affect the market. Number one is corporate earnings in India. India is kind of insulated from the global slowdown and the global issues. Of course, the oil impact is very, very serious for us. But assuming oil goes back to $80 $85 per barrel and settles there, we will not have major macro shocks, which means the focus will shift to India's domestic consumption and domestic demand. And that will translate into corporate earnings. So, any sector which is dependent on Indian demand and consumption, the focus will be on ensuring that their EPS is growing at mid teen levels or even higher than that. So corporate earnings becomes the first trigger to make sure that we go back to all-time highs. If we are able to grow Nifty EPS at about 15% CAGR, I think we will be fine in terms of market growth. The second important trigger that we have at this point in time is foreign portfolio investors. They have been heavily selling from India over the last 2.5 years. March was brutal again on selling. I genuinely think that we are probably on an undersold level as we speak, which means that any more slowdown in selling by foreign investors will result into a regime where market will see it as a positive sentiment for Indian equities. And the third is valuation. The March correction has made sure that Nifty valuation on a trailing basis is under 20. It is something that we have come to after many years, and it's a very, very comfortable zone for many investors to start going long into Indian equities. So these three important factors will now drive the Nifty levels going forward. We are still about 10% lower than all-time highs that we touched in February. My sense is we will go back to that probably later during the year, and from there a new trajectory for growth may come in. Focus of investment now should be on sectors that are primarily driven by Indian demand and Indian consumption. The rest of the world is not doing that well, so sectors which are dependent on rest of the world for growth will get affected. If you can keep a portfolio which is diversified into Indian domestic consumption themes and keep on investing regularly even when market corrects, it would be a good recipe of creating wealth over the next 3 to 5 years. Please remember, history always tells us that when you invest more in situations like this, the wealth creation is always at its optimum. If you want to know specific inputs about your portfolio and your wealth journey, please reach out to us. Thank you.